Getting underway today, and some growing optimism, perhaps, among CNBC's Fed survey participants about the outlook for markets. Steve Leisman has the details for us. Steve?
Yeah, David, a little bit brighter when it comes to the outlook for stocks, with respondents to the CNBC Fed survey lowering their recession probability and seeing more of a bounce back in the economy and stocks in 2026. Year end, we're looking at 61.33. That's just up 1.5. But things look better for 2026. 66.25 on the S&P. That's up nearly 10% from yesterday's close. Hank Smith at Haverford Trust writes in with the survey: equity markets are near all-time highs in anticipation of certainty replacing uncertainty on tariffs, the 2017 tax cuts getting extended, deregulation, AI productivity, and Fed easing. If all this occurs, the economy should reaccelerate in the second half into 26. 10 years seen a bit higher at 443, up from the prior survey, but below the current rate, and also a little bit better, but still higher in 2026 relative to the prior survey. On the tax bill, 43% believe it will significantly increase the deficit, 39% somewhat increase, call it 82% think that this tax bill will indeed increase the deficit. And respondents, our 28 respondents, are divided when it comes to the outlook for the tax bill when it comes to growth. 29% say it will, they're more optimistic on growth, 29% say less optimistic, 43% say it doesn't matter. Here's the outlook for the Fed: 100%, no change for this week, and 100% next week, not 100%, but no expectation for a rate cut next month. But 38% is the recession probability. That's down a bit. And you can see there are 2 cuts built in for this year, just 1 for next year, with the funds rate remaining above the long-run neutral rate into 2026. Bottom line, outlook is a bit brighter than it was in May, but still depressed from January. There's a growing sense the economy absorbs all these changes and finds its footing in 2026. Guys?
So when we look at this, what does this mean? He basically stated that the Federal Reserve is looking to keep rates stabilized right now, and they're looking to cut later on in the year, right? What is Federal Reserve and what is the Fed when it comes to Treasury rates? How does that help? Well, businesses, right? If you got a higher yield, which is mean a higher rate, everything is more expensive, right? The power of money is more expensive. Borrowing money becomes more expensive, right? Your housing cost when it comes to your interest rate when you buy a home is more expensive on that loan, right? So the higher the yields are, the harder it is for businesses to make money, as well as for you as an individual and as a consumer to get loans at a lower price, right? Years ago, when it comes to the pandemic, we was buying houses at 3% interest rates. Currently, right now, we're sitting at an interest rate of around 7 to 7.5% to buy a house, based on the Treasury yield of what the Federal Reserve, when it comes to the United States and getting loans, what they base that off. So the higher the loans are, higher the yields are when it comes to the Treasury rate, the higher your loans will be when it comes to your interest rate with houses, with cars, with personal loans, etc. Any type of borrowing money, it's going to be more expensive. So that outlook when it comes to 2025 at the end of this year into 2026, if you see rates come down, then it's better for the consumer. It's also better for the businesses as well as the stock market as a whole, because lower yields mean easier to do business. It costs less money. Ultimately, profits are in a more positive rate when it comes to businesses, which ultimately affects the stock market in a positive way. So it's important to be aware of what the Treasury and the Federal Reserve is doing, because then that plays into businesses, that plays into the stock market, that plays into you as a consumer when it comes to loans and trying to borrow money for houses, cars, personal loans and everything. So in that realm.
So is the view that the Fed should look through the tariff inflation or not?
So, yes, if the tariff inflation can be looked through. Sarah, I'm sorry to throw it back at you. That's really what it amounts to. I will say, by a 4-3 margin, they do think the tariffs end up being one-time price increases. 43% to 32% think it creates a broader inflation. If the 43% are right, then the Fed can and will look through it. ends up creating a broader inflation problem. I will say this, Sarah, 61% do say that tariff inflation is yet to come in the months ahead. They don't think that what we've seen the last month or so is indicative of what's going to happen from price increases from tariffs.
Okay, now one person.
When it comes to tariffs, right? And this is where it gets a little interesting in the coming months. Tariffs was put on countries at an alarming rate in April, right? Tariff inflation is not going to affect us until about 90 to 120 days after the tariffs, because there's a process. And obviously when it comes to business, if we're shipping, things from China, Vietnam, and other places, those shipments take a little bit of time. So if I put orders in back in March and April timeframe, tariffs came about in April, and in that early May timeframe, then the cost of goods are going to go up, or has gone up, when it comes to doing business back in April and May. So when will that impact inflation inside the United States? It's going to start in July, right? So if the market reacts positively to less inflation, which is also the Fed's mandate, which is to lower inflation, then that basically means that inflation goes up, even for a short period of time, then the Fed will not lower interest rates. And the stock market could be impacted in a negative way. So when I said there will be opportunities in the coming months to be able to tackle, stock prices and stock picking when it comes to buying stocks, we're going to see that over the next 3 months, right? If you missed out on that dip in April, understand there will be another one. It might not be nearly as significant as it was in April, because that was a bloodbath. But when we're talking about July, August, and then early September, there is another opportunity coming for you to buy stocks at discounts when inflation starts to creep up in that second to third month of the summer, and then that early fall timeframe, right? So be aware of the coming months and how that inflation can impact not just you when it comes to buying goods and services, but also if you are, investing in the stock market, how can then that impact, the market as a whole, ultimately coming down a little bit in the next couple of months. We're going to continue this market conversation and talk strictly about just the S&P 500 and the stock market as a whole, and that forecast that we have for now till the end of the summer through the fourth quarter, which is the end of the year.
Real developments there. A Fed meeting coming in a couple of days, at least the decision, and the G7 ongoing, as you saw earlier, that bilateral between President Trump and Canada's Carney. All our eyes on everything today. Joe Terranova, Carrie Firestone, Jim Leventhal with me at the desk. So, Joe, we have Iran signaling, according to the Wall Street Journal, that they want to negotiate. The president all but corroborating that in the little spray they had with reporters at the G7 Fed decision. Yep. Oppenheimer says downward pressure on stocks is unlikely to be a protracted overhang. Is that how you feel as well?
That's how I feel, and that's what the market is telling us. We have the NASDAQ 100 and the comp both above Thursday's close. The S&P 6045 was the close on Thursday. We're about 4 or 5 handles below that right now. So we've made this dramatic recovery. 16 52-week highs for S&P 500 companies. You've got IBM, Microsoft, Palantir, Darden, Dash, some names that I've mentioned frequently. And yes, we continue to show the resiliency in this market. And what's interesting to me is not even the geopolitical aspect of it, is the inability with the geopolitical events to see relief in treasury yields. We didn't get the buying in treasury yields. Maybe the markets were pricing in some inflationary outcome from oil. I'm not sure. I don't think anyone ultimately really knows.
There are like 5 different hypotheses on why yields were doing what they were doing on Friday. and almost got a different answer for 5 different people that I interviewed on either program on Friday, either halftime or closing bell. It seems like I got a different answer.
I agree with you. And the reality is you have a 10-year sitting at 4.40, and that was supposed to be a challenge and a problem for markets. But here we are, the S&P 60-40 pushing towards a new all-time high, and I still believe that's where we're going.
Carrie, it feels like when that headline crossed that Iran was signaling that it wanted to negotiate with Israel, the market got a little bit of a pickup off of that. We've pretty much held it. We're off a little bit from where we were. But do you agree with Oppenheimer today that whatever downward pressure comes to stocks because of geopolitical events or otherwise are unlikely to be a protracted overhang?
No, I don't think I agree with that. I think they're trying to broad brush say that the market is going up, regardless of what happens.
And you don't agree with that?
I think the market has certain constraints that are built in, and we've seen it this year already several times. The market gets to the 22 times forward earnings, and it seems to be pushing up against a ceiling. I know that the markets can trade to 23, 24 times, but this market seems to have trouble pushing through that, and I blame that on concern about earnings growth. And it could be earnings growth or less than expected earnings growth that's a result of tariffs or any kind of events or inflation or just the employment situation. We haven't had a bad situation with employment. It's all positive. But that's what the market begins to worry about. So I think we're still in that range that's bound by valuation to some extent rather than by what's going on from either Trump's conversations or what's happening in terms of who's bombing who.
Krinsky at BTIG is looking at a choppy summer ahead, that the S&P is into formidable resistance at 60.50 to 61.50. Pay attention to where we are now. We're at 60.36. That you have initial support at 59.70. I know we're throwing out these numbers out, but that's what the technicians sort of do for a living. Major support at 5,800. So as long as that holds, the bulls maintain the upper hand. And we're
going to stop for a second, right? And we're going to speak to the market currently right now. And what I want to do is I'm going to make this a little bit bigger. In April, we were at 500, right? And let's take away the zero. So you see 60.50, right? I want you to take away the zero. We're just going to speak to 605. Or you see the 597, we're going to speak to 597. We're not going to look at the 5970 because that's SPX, and SPY just takes away that zero. So it makes it easier for you to understand when it comes to numbers. In April, we were at 500, right? And then we came down to 487. The greatest opportunity to buy was at that 487 level. And even buying at 500, that was a great entry also. If you were new to the market, or even if you're trying to rebalance your portfolio, that 500 to that 480 to 500, even 520 level was just an amazing opportunity, right? So right now we're at around the 600 level, right? We fluctuate between 599 and 601-ish for the last couple of days, right? What they're saying here is we have resistance in the market around that 605 to 615 level, right? So we have a range-bound market currently over the last couple of weeks, but it's been moving up consistently. Our support is 597, and major support is at 580. And this is a forecaster when it comes to, analytical as well as technical analysis when it comes to the market and resistance and support levels. I'm not getting into all of that really right now because that's an advanced level conversation. But what I want to get across is if you pay attention to the levels, they tell you when is a good opportunity for you to get into and buy more. You don't want to buy at 610, 615. You don't want to buy at the top of the market. You want at all times, you want a 10 to 20, 25. If you can get anything better than that % discount when it comes to the stock market. Now, different stocks might go down a lot more than others, right? So Microsoft might range differently than Apple versus Nvidia versus Palantir versus, Netflix or whoever you want to invest in. But the stock market as a whole moves when it comes to these numbers at a 5 to 10% clip. At one point, we were down 10, 12, 15 possible percent when we were down to that 500 level. Now we're back in the 600, the 601, 602 level, right? They're saying that there's a range up in that 615. There's support down at 597. If it goes below 597, you can get down to that 580 level. I'm actually, and a gentleman's about to speak on it, I want to buy at 570. That is the range that I want to get into in the summer. So right now, I'm not buying anything. I'm waiting for opportunities to come, which they will come later on in the summer as well as the early fall. So my recommendation, and really just my rule of thumb is, if you got stocks at a 10, 20% discount and you see the great companies that you want to buy, you want to purchase, wait, be disciplined, stack the bread over the next couple months, and be ready. And be ready. Again, as I say, take advantage of the opportunity when it comes. Be ready to take advantage when the opportunity presents itself.
You can expect new highs later on in the summer. Makes sense, Jim?
I think pretty soon, frankly. Look, we're 1.5% away from an all-time high, and we know what happens regardless, Carrie, of the analytical skills, which you just displayed, which I love as well. Once you get to that all-time high, FOMO hits in. It's going to happen. It has nothing to do with numbers or forward multiples. It has to do with people looking at what's going on and saying, I want in. I think that's what's going to happen. I think it's going to happen soon. And I actually think the numbers support it from this perspective. If you look at earnings estimates for next year, and I know this is a long way away, $300 a share. Carry 22 times $300 a share, $6,600. Now, the question here is, are we actually going to hit those estimates? Well, that all depends on trade deals coming through, the tax bill getting through. And I actually think those are going to happen and that you'll get a clear runway. So, Scott, when you were talking about Krinsky and the chop, that chop to me is what happens in the summer as people shift from looking at 2025 earnings to looking at the year ahead earnings. And it's not a perfect transition. It's choppy as it happens. But if you get some trade deals, if you get the reciprocal tariffs down to a reasonable level and the budget bill in place, this market goes higher on FOMO.
So maybe it is FOMO. Joe, I thought that note today from Goldman Sachs sets the table for so many different layers of this conversation, that households' allocation to equities hits a record high. 49% of their total financial assets are in equities, the highest level on record, and slightly above the previous peak of 48% in the year 2000. That suggests to them that if you continue to get high allocations to equities, you obviously have support for where the market is, and you support the valuations that some have here questioned.
Yeah, I think what's interesting is that households really never moved to the sidelines when we had the sell-off in April. It was institutions that were moving to the sidelines. I respect your argument about 22 times being a little bit rich. Jonathan Krinsky saying the markets could chop. I don't know if that's a reason to sell, though, because I think all that means potentially is you soften somewhat over the third quarter and you pull back maybe to 5,500 and 5,700. And from there, where do we go in the fourth quarter? So I don't use that as a reason to sell.
But I would sell.
I think more it's set the expectation. Okay, maybe you are not breaking out above the all-time highs that Jimmy and I see coming. Maybe you get up there and it's a little bit of a short-term trap. But I think over the next 6 months, there's continued support in the form of strong corporate earnings and potentially in the form of some regulatory relief.
When I see the Goldman note today, I'm like, well, okay, Robinhood, Interactive, Schwab, you can throw them all up.
ICE 52
one after another, because it's part of the obvious place to look. Carrie, you have Schwab.
Yeah.
Was reiterated by today at Truist. The price target $100. You see Robinhood was up. There's Interactive Brokers up 4%. We can take that before we get to the next layer of the conversation.
Yeah, I think one of the factors that's really helping those stocks is not just the hope and the belief that there'll be deregulation, but we've seen that interest rates are not giving you more of what people who say, oh, look over here, you can have 5%, maybe 5.5% on your money. You don't have to speculate in the stock market. Well, that really hasn't happened. People are still employed. We're at the low unemployment level that we've been at for years. They've got money to invest, and the place to invest it has been markets and not in bonds.
Yeah. it's like, well, where are they trading if they're, have just such a high allocation to equities? You look at the obvious places that we just did, among others. Then what are they buying? Technology is the leading sector off of the April lows, as I don't think is going to surprise anybody, along with comm services. Big tech's furious rally forces options pros to line up hedges. That's according to Bloomberg today. And you have a number, Jim, of names within the tech complex that continue to rise.
And of all stripes, frankly. So I'll start with NVIDIA, which is everybody's favorite, right? I mean, what is it, about 6% from an all-time high? Much like the market, I think it's just going to get sucked up there. And once it hits that all-time high, again, Gary, FOMO, it happens. But if you want to look, and basically, whether it's the market or the technology sector, this is a stock picker's market. So if you're somebody like me, you're looking at stocks that are value tech, but which are doing phenomenally well. You can look at a Cisco Systems. You can look at a Qualcomm. You can look at a Google, Alphabet, which we've been talking about a lot in the past few weeks as a value tech stock, but stocks that are starting to work. So you don't have to just kind of hold your nose and buy the most expensive technology stocks out there. As I said, all stripes of technology stocks are working, and for the very good reason that that's where earnings growth is.
It's been remarkable.
It's very important that you understand the future of the world, right? We had a conversation about artificial intelligence and how we need to invest, right? I have a whole video that breaks it down, So, if you go back on the channel, you can see that video. And we talk about AI stocks, we talk about NVIDIA, we talk about AMD. We had conversations about a lot of different stocks, but it's important that we know which companies are profitable, that have future earnings estimates in a positive, that will continue to propel forward the United States of America, as well as do business around the world. The one company that we know is NVIDIA, that we know is going to do that, and it's the darling in the stock market currently right now, right? But I want to continue to implore you guys, as we end this stock market discussion, to not buy at the high of the market. A part of investing is discipline, is patience, and understanding that markets do come back down, right? We're going to have a roar up. We're going to have a very subtle dip when it comes to the fall and the late summer to early fall. And then around October, middle to late October, as we see every year, there's going to be a roar in the fourth quarter to end the year. So when you buy is so important. You don't want to buy when it's at the high. You want to wait for the discounts. The same way we go to the store, the same thing that we do at, Foot Locker, or we go and we want to see these 20 to 30% holiday deals, right? We take advantage of those deals when they come, and we pour in when it comes to buying whatever we need, right? Any type of, not clearance, because that's a whole different conversation, but any type of deal that you see in the buying things, we want to take advantage of those. The stock market is very much the same thing, right? You don't want to get caught up trying to chase. And if you missed on NVIDIA at 95, if you missed on Google at 140, if you missed that, AMD was down to about $60 or $70 a share. It's up to about 120 right now. If you missed on Tesla coming all the way down to 210, 220 level, and then it went all the way up to 350, 370, and now it's settling around that 320, that 315 to 320 level. That's okay. Be patient, right? Pay attention to what the stock market is doing. We got geopolitical issues. We got issues around the world. We got this Iran and Israel situation that very much the United States is getting involved in different ways. We got China saying things. We got Putin and Russia saying a bunch of stuff. Understand that in certain situations around the world, how that affects the market, there will be opportunities to continue to invest. But you don't want to chase. You don't want to do FOMO, fear of missing out. We don't want to get involved in that process. We want to wait for these dips, these opportunities to come in the stock market.